that we expect to have a useful life greater than a year. So that's one of the main differences. So a significant number of U.S. companies use LIFO in measuring inventory. Okay, LIFO is, I'm sure you know, is last in, first out. This method is not acceptable in most other countries. So most other countries either use FIFO, first in, first out, or weighted average. And so for over 4 decades, efforts have been made to reduce the differences that exist in financial reporting across countries and converge on a single set of global accounting standards. And, I think it's important to think about why would we want to do that? Well, the why is that we're in a global world, or global financial markets. And so if we want access to capital across the globe, then we want people to feel comfortable being able to make rational decisions. And one of the primary ways they make rational decisions is to be able to read financial statements, compare them to other financial statements and of like companies in similar industries. And so the more we can converge to one set of standards across the world, the more it should ease the burden of trying to figure out, well, what are these reports actually saying to me? And thus increasing access to capital across the globe. So international accounting diversity, international accounting standards, the work that has started by the International Accounting Standards Committee and now the International Accounting Standards Board continues to develop international financial reporting standards. So today, publicly traded companies, I think it's up to 130 countries now around the world use IFRS, so International Financial Reporting Standards, to prepare, consolidate their financial statements. So this chapter describes the process of international convergence of financial reporting, focusing on the work of the IASB and recent efforts to converge US GAAP with the International Financial Reporting Standards. And it's clear right now we're not fully converged between these two standards, and there are many differences that exist. So let's jump into what some of those things are. So before we jump into what the differences are, let's focus in on what drives accounting standards. So there are at least 5 essential reasons for accounting standards and their differences. The legal systems, the taxation systems, the financing systems, inflation, and then political and economic ties. So when we look at the legal system, England and the United States have something called common law. So we're going to find that primarily in English-speaking countries. Common law countries rely on limited amount of statute law interpreted by courts. And so common law basically says that we have a set of laws that were put in place, and we try to follow those. There's something called stare decisis. So corporation law might lay basic framework for accounting, but the accounting profession or independent non-governmental body representing the variety of constituencies establishes specific detailed accounting rules. So then there was the Roman codified law followed in most non-English speaking countries, originated in Rome, tends to have relatively more statute or codified law. Corporation laws establish basic legal parameters governing business enterprises, often stipulates which financial statements must be published in accordance with prescribed format. Accounting profession tends to have little influence. Accounting law tends to be rather general, does not provide much guidance regarding specific accounting practices. So at the heart of this is a fundamental difference of our legal systems. And then there's taxation issues. Financial statements are the basis for taxation in some countries. Other countries adjust financial statements for tax purposes. So in the US, we adjust for tax purposes. So we have GAAP, which is for financial reporting. And then we have the Internal Revenue Service or the tax code, which is for filing taxes. And every country is going to be a little bit different. Some just take whatever is in the publicly reported, and that's what is the basis for taxation. So financing system. So financing system is how do we raise capital? Differences in financial reporting purposes is argued to be the major reason for international reporting differences. The most relevant factor in determining the purpose of financial reporting is the nature of countries' financing systems. Countries with a strong equity outside of financing system use a less conservative Class 8 accounting system, which provides more disclosure and does not follow tax rules. So that would be the United States and generally accepted accounting principles. Countries with a weak equity outside of financing system have a Class B accounting system, which is more conservative. Disclosure is not as extensive, and financial reporting more closely follows tax rules. Then there's the issue of inflation. Inflation was dormant in the United States for a couple of decades, but it's reared its head over the past 12 to 18 months. So the problem with inflation is that it can render historical cost as less meaningful or useless. High inflation rates compelled the development of accounting rules that require inflation adjustment of historical cost amounts. So as I said, in the US, GAAP has not really had to deal with this issue in the past 3 or 4 decades. Not always the case in other countries, though. Other countries experience high rates of inflation. So they're going to have to deal with this issue about how do I restate the historical values of things if inflation has made them less meaningful or meaningless. So although it was necessary to use for a while in Latin America, inflation accounting has been abandoned throughout the area, at least for the time being. So political and economic ties. Accounting is a technology borrowed relatively easily from or imposed on other countries. Through political and economic linkages, accounting rules have been conveyed from one country to another. British-style accounting systems can be found in countries such as Australia and Zimbabwe. French accounting is prevalent in the former French colonies of West Africa. Recently, nations of the European Union, a political and economic union, have adopted a common set of accounting principles called the International Accounting Standards, or IFRS. Okay, so now let's talk about understanding the problems created by differences in accounting standards across countries and the reasons to develop a set of internationally accepted accounting standards. So diversity in accounting across countries causes problems for both preparers and users of financial statements. The preparation of a consolidated financial statement by companies with foreign operations usually require companies to keep books in the local currency and follow local accounting principles. Companies that want to gain access to foreign capital markets and obtain capital by selling stock or borrowing money in a foreign country might be required to present financial statements prepared in accordance with that company's accounting standards. And then there's the lack of comparability between companies using different accounting standards complicates the job deciding which company to invest in or loan money to, right? So it's a capital access issue. And really, when you think about accounting standards, one of their primary objectives is to allow the stakeholders, capital investors and creditors, to make rational decisions about investing or loaning money. So access to capital is a big reason why we have accounting standards. And so when we have differences, it makes things more challenging. So due to these problems associated with worldwide accounting diversity, work to reduce accounting differences across countries and establish a single set of global accounting has been ongoing for more than 4 decades. So the International Accounting Standards Committee was established in 1973 to eliminate the diversity of principles throughout the world. The primary objective was to develop an international accounting standards. They had no power to require the use of standards, but member accounting bodies pledged to work towards the adoption of one set of standards. Their IAS was approved by a board consisting of representatives from 14 countries. Okay. So early IAS followed a lowest common denominator approach and often allowed at least 2 methods for dealing with a particular accounting issue. IAS 2, originally issued in 1975, allowed for the use of specific identification, FIFO, LIFO, average cost, and base stock method of valuing inventories, effectively sanctioning most of the alternatives in the worldwide use. IAS allowed the traditional U.S. treatment of expensing goodwill over a period of up to 40 years, and the U.K. approach of writing off goodwill directly to stockholder equity. Okay, so you can see all of these things are going to start to create problems. So the International Organization of Securities Commissions, a member of the IAS Consultative Group, is composed of stock exchange regulators in more than 100 countries, including the U.S. Securities Exchange Commission. As one of its objectives, they work to facilitate cross-border security offerings and listings by multinational issuers. Due to the comparability project, 10 revised IAS were approved in 93 to become effective in 95. In 93, the two groups agreed upon a list of core standards to use in financial statements of companies involved in cross-border securities and listings. The IAS issued or revised 16 standards in 97 and 98. In 2000, the technical committee recommended the security regulators permit foreign issuers to use IAS standards to gain access to countries' capital markets. Many stock exchanges around the world implemented the recommendation. Okay, so these are some of the things that people have been working on over the years. So list the type of authoritative pronouncements that constitute the International Financial Reporting Standards. So the International Accounting Standard Board succeeded IASC in 2001. They adopted all international accounting standards issued by the IASC, announced that its accounting standards would be called International Financial Reporting Standards, or IFRS. So the authoritative pronouncements that make up IFRS consist of these: International Financial Reporting Standards issued by IASB, International Accounting Standards issued by IASC and adopted by IASAB, interpretations issued by the International Financial Reporting Interpretations Committee, interpretations issued by the Standards Committee. So the IAS issued 41 standards from 75 to 2001, and IASAB issued 16 as of through 2016. I think it's up to about 23 now. Several IAS have been withdrawn or superseded by subsequent standards. So that happens with FASB as well. As of January 2016, 21 interpretations were in effect. The two sets of standards and two sets of interpretation comprise what IASB refers to as IFRS and can be thought of as an international GAAP. International GAAP constitutes a comprehensive set of financial reporting standards that cover most major accounting issues. They have a conceptual framework for financial reporting that provides the basis for determining appropriate accounting treatment, not covered by specific standards. So let's look at how they're used around the world. Countries can use IFRS by adopting IFRS as national GAAP. Okay, so that's probably the most prevalent way of doing it. Requiring domestic listed companies to use IFRS in preparing their consolidated financial statements, allowing domestic listed companies to use IFRS, and requiring or allowing foreign companies listed to use the standards. Of the 139 countries using it as of June 2015, 92 require all domestic listed companies to use it. 28 of them are in European Union. All publicly traded companies in the EU are required to use international financial reporting systems. The two significant exceptions are China and the US. So standards for business enterprise, standard for business is substantially converged with international financial reporting systems. And so Chinese companies on the Hong Kong Exchange are permitted to use either Hong Kong GAAP or international financial reporting systems. Two primary methods used to incorporate the international GAAP into their financial reporting for listed companies are full adoption of international financial reporting systems as issued by IASB without any intervening review or approval, and adoption after some form of jurisdictional review and approval process. So explain the purpose of IFRS for small and medium-sized enterprises and how it differs from full IRS. So this is an important distinction, which we don't have with GAAP. So this is to try to facilitate small businesses that can be tied down by trying to comply with very complex rules and procedures. So there are approximately 28 million private, non-publicly traded companies in Europe, another 25 in the United States, not to mention parts of the world. Non-public companies are often referred to as small and medium-sized entities, or SMEs. So the International Accounting Standards Board created a less complex set of standards in 2009. We'd like to have something like that in the United States with GAAP, but we don't. So less than 250 pages in length, which is probably about 10% of the size of IFRS today. And so full IRS topics deemed not to be relevant for private companies or omitted. Significantly fewer disclosures are required, approximately 300 disclosures for SMEs compared to 3,000 for, so it's 10%. Principles for recognizing and measuring assets, liability, income, and full IRS are simplified. All borrowing costs are expenses incurred. All development costs are taken care of. Goodwill is amortized over the useful life. Property, plant, and equipment cost models must be used. Benefit plan, actuarial gains and losses are recognized immediately. So the standards for smaller business available to any country who adopts international financial reporting systems. Okay, so that's a big benefit that we should really think about in the United States. So understand the steps to be taken to prepare international financial reporting financial statements for the first time. Okay, so this is always going to be a big challenge, right? Whenever you're doing something for the first time. So publicly traded companies in more than 100 countries have been required to stop using their old accounting standards and adopt the international financial reporting standards to prepare consolidated financial statements. The process of converting from one set of accounting standards to another is complex, and many questions need to be answered. So their standard 1 establishes procedures to convert from previously used accounting to IRS for the first time, introduce the concept of opening balance sheet. Okay, so this is opening balance sheet for the first time. Requires companies transitioning to the new standards to prepare an opening balance sheet at the date of transition. The transition date is the beginning of the earliest period for which the entity presents full comparative information. So we're going to show what it was like under the old standard and what it's like under the international financial reporting standards. Okay. So steps that have to be done to determine the applicable international financial reporting standard. Recognized asset liabilities required to be recognized under the new international not recognized the previous GAAP, and de-recognized assets and liabilities previously recognized that are not allowed to be recognized under international financial reporting systems. Measure asset and liabilities recognized on opening balance sheet in accordance with the new standards. Reclassify items previously classified as in a different manner. Comply with all presentation and disclosure requirements. So it's a lot of work, very tedious, but again, the reason for doing it is companies need access to capital. Companies want to have their stock traded, and investors are only going to feel comfortable if they know what they're looking at. So after they've been prepared, the company continues to use the international financial reporting systems. And they're going to reconcile their old for a couple of years, and so forth. Okay, so accounting policy, change in accounting estimates and errors, establish the hierarchy the firm must follow when dealing with accounting issues. Apply specifically relevant standards. Refer to IAS standards dealing with similar or related issues. Refer to the definitions, recognition criteria, and measurement concepts. Okay. All right. So what's left in terms of the conversion process? So there was a conference in 2002. It was actually in Norwalk, Connecticut. And the goal was convergence, right, to one set of standards. And there has been progress made, and they continue to meet. But keep in mind, these efforts are not a full-time focused effort. These are, part-time efforts, and So, but they're focusing on these particular issues: business combinations, discontinued operations, fair value, goodwill, etc. So there's a lot left to be done here, is the bottom line. But what's important for us to recognize right now is that there's a difference in standards. In some cases, it's significant. There's a lofty goal of trying to converge it to one. I wouldn't expect that's going to happen anytime in the near future for a variety of reasons. But you know, that's the bottom line in this discussion. Okay, so I think that's enough to get us going, and we will. So in terms of what you need to do, I'm going to make available the Kahoot questions to help you get ready for the graded assignment. So do the Kahoot, do the graded assignment, watch the other video that I've posted, and then let me know if you have any questions. Okay, so thank you very much.